Hello, everyone. Welcome to today's non-farm payrolls webinar. This is the first non-farm payrolls report for the year 2022, and the data is for the month of December of last year. So today, my colleague Victor is still on holiday. For those of you who have joined us live, thank you so much for joining me. For those of you watching a recording of this, please consider joining us live next time so that you have the opportunity to ask me questions live during this webinar. Before we start, please have a quick read through the risk warning and the disclaimer on the screen right now. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think market shall not be responsible for any loss that you incur, either directly or indirectly arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So this webinar happens every first Friday of the month. That's when we have the jobs report from the US published. And the way it works is I usually talk about some of the leading indicators to try and come up with a rough estimate for the headline jobs number. And then we look at the live charts to provide actionable trade ideas for you guys. In this particular webinar, I'm not going to do it this particular way because I reckon the headline jobs number is not that important anymore, because the Fed is becoming really hawkish. The minutes of the December's FOMC meeting was released a couple of days ago, and judging by what the Fed said in those minutes, it looks like a rate rise in the coming months, possibly as early as March, could be on the horizon. So if today's jobs report doesn't disappoint and we see wages, now wages is going to be very important now because we've seen price inflation already reaching multi-decade highs in the US. In Eurozone, we saw inflation reaching 5% today. And elsewhere around the world, inflation is also rising. So inflation is the main concern for the Fed now, because employment is near levels it was before the pandemic, and the economy has grown quite strongly from the pandemic. So the Fed is really concerned about inflation, and this means that today's jobs report is going to be important, but the wages aspect of the jobs report is probably going to garner more of the attention today than usual. So let me just quickly remind you that I did write a NFP Preview article earlier today. If you haven't had the chance to read it, it's not a very long article, but I just want to highlight a few things that in terms of earnings, average hourly earnings, we are expecting to see another 0.4% rise month over month in earnings in December. The year-over-year rate is expected to have eased slightly to 4.1% from 4.8% the previous month because of the impact of base effects. The headline jobs report is expected to print 425,000 new jobs. So those are the key numbers to look out for: 425 on the headline front and 0.4% on the earnings front. This week we had some of the leading indicators come out stronger than expected, which means that we may well see a positive surprise this time around. So let me just quickly go straight to the charts. And the first thing I want to highlight is this here. This is the 10-year US bond yield daily chart. As you can see, it has started the year on the front foot. Yields have climbed to their highest level since April of 2021. So it looks like a breakout is happening here, and we could be heading a lot higher in the weeks and months ahead. For as long as we don't see a lockdown in the US because of the spread of the Omicron variant of COVID, or some other bearish fundamental stimulus coming into the market. But as things stand, it looks like yields are going to rise further. And this should provide support for the dollar, in my view, especially against currencies where the central bank is comparatively less hawkish, or not hawkish at all in the case of the Bank of Japan. So, rising inflation in the US is going to cause the disparity between the US and Japanese bond yields to grow even wider. And that in turn should keep the dollar yen supported, regardless of the outcome of today's jobs report, I reckon. Speaking of which, let's quickly look at the dollar yen now. And this is going to be the chart to watch, if you like, insofar as today is concerned. And I'm going to start off by looking at the very long-term picture. We're looking at the monthly chart here. As you can see, following a multi-year consolidation, rates broke out last year and held the breakout for several months before accelerating in November to the upside. In November, the bears tried to step in because of the correction in the equity markets. However, by the middle of December or start of December in this case, there wasn't much further downside follow through, and the dollar yen closed the month of December on the front foot, and it has started this year by breaking out to a new multi-year high. So in the grand scheme of things, today's jobs report is not going to matter too much, I don't think. And the long-term trend is clearly bullish, as you can see. Indeed, there's even a very long-term inverse head and shoulders pattern, as you can see right here, which is in the process of being formed. What's important though is the trend is bullish, and so we are looking to buy the dips, right? We don't want to be going against the trend, especially against a strong trend backed by solid macro backdrop, which I mentioned earlier. So looking at the chart here on the daily time frame, the 1-year-old bullish trend line is well below current market prices. There is a shorter term bullish trend line coming in around 114.50 area if we get there today. I reckon the more likely outcome is we might see a little bit of a downward move if the data disappoints on the headline front, and then that dip is likely to be bought. If the data comes in really strong, then we might not even see that dip. Rates could just resume higher from there and head towards the Fibonacci extension level shown on the chart. We've already reached the 127.2% extension of the move down from here to which was this high in November, which ended at the end of November, started on the 24th and ended on 30th of November. So it was a very fast sell-off, broke below this low, but there was no downside follow through, and that hesitation there was the first sign that the sellers were getting into trouble. But now we've completely invalidated that bearish move because rates have broken above the high of that move down. So this area was previously resistance, right? We've broken above it. Once resistance, this area should in theory, turn into support on retest from above. So any dips into the zone around 115, 50 area is likely to be supported in my view, leading to further strength in the days and weeks ahead. If it plays out this way, watch for potential resistance around the 161.8 extension, which is at 117.37. Notice how price has responded to the 127.2 extension. This is purely driven by profit taking, in my view, ahead of the jobs report. Thereafter, the 200% extension comes in at 118. But given the long-term breakout that we saw in the monthly chart, there's no reason why this thing cannot go even higher over time. I reckon 120 is on the cards in the weeks and months ahead. But obviously, insofar as today is concerned, it's all about the jobs report, and this area is likely to be very important. Let's have a look at the hourly chart. So on the hourly chart, that high from last year at 115.50-ish is going to be very important. But in case, price doesn't get to this level or it gets hit here and then quickly rallies or whatever, and you want to wait for some sort of confirmation, then perhaps if you wait to see whether or not the dollar yen could climb out of this triangle pattern or whatever formation this is. It's a bullish continuation formation, isn't it? Once it gets out of this range to the upside, then you could look to buy potential dips back into the zone for a short-term trade, for a short-term long trade, I should say. If for whatever reason you're feeling bearish on the dollar yen, perhaps because you're concerned that a very strong jobs report might cause the equity markets to sell off, and that in turn may cause the Japanese yen to strengthen because of safe haven flows, then in that case, you need to wait for a confirmed reversal signal on the daily time frame before looking to potentially sell the dollar yen. Or you could just simply look to sell, the Nasdaq, which is more sensitive to rising yields in the US than this currency pair. So speaking of which, let's quickly go there and have a look at the Nasdaq. The Nasdaq is a tech-heavy index, isn't it? And technology stocks have been leading the stock market rally over the last several years, and in the last 5 years they have outperformed the rest of the market. I'm looking for the Nasdaq 100. I can't find it here. I may have deleted it. It's all right. I can add it. US. There you go. US 100. So yeah, looking at the chart of the Nasdaq, let's have a look at the weekly time frame first of all. The index has not created a higher high this year compared to, for example, the S&P 500. Sorry, the Nasdaq was here. Yeah, this is the chart. Get rid of this one. So the Nasdaq has not created a higher high above last year's high compared to, for example, the Dow. Dow rose above last year's high hit at the end of last year before pulling back a little bit. Likewise, the S&P 500 momentarily hit a brief high above the previous year's high before pulling back. These lines I had drawn in a previous webinar, in one of our previous webinars, maybe a few months ago, indicating the potential bullish scenario for the equity markets. I mentioned then that I don't think the S&P 500 would be climbing very sharply from current levels because of rising bond yields and the fact that the Fed is now withdrawing a stimulus. So at best, I thought then that we may see sideways price action, a bit of a move up then down, which is basically what's happened. In terms of worst case scenario, I thought we may see a more significant drop. This scenario has not played out. It may well do in the future, but right now is the bullish scenario, which is consolidation near the recent highs. Anyway, going back to the Nasdaq chart, it's testing this long-term bullish trend line that has been in place since March of 2020. There are several ways you can draw this trend line actually, because you could have drawn it like this. In this case, it was already broken, right? Retest, sold off, and then get rid of it. I think connecting these lows make more sense now. This low, this one, and extending the line to the future. So this is more of a stronger trend line to look out for. I can get rid of this one now. Here you go. So this one is a 1-year-old bullish trend line, and as you can see, it's possible we may see some further weakness before the buyers potentially step in. Right? Let's have a look at the daily chart. So that trend line I drew is I think it's this one. Yeah, connecting the previous lows. Yeah. This trend line is more of a shorter term trend. We broke below it briefly yesterday before the market bounced back from support at around 15,700, which was previously resistance and support. So this level has been tested at least on 3 separate occasions. And if we close the day below this level, it would be a significantly bearish development in my view, which could then pave the way for a drop to at least this trend line, but possibly to the 200-day moving average, if not more in the days ahead. So yeah, the reason we're looking at the chart of the Nasdaq is because if you think that we will see a significantly positive jobs report, which would cause a sharp rally in bond yields, then we may well see the Nasdaq break down. Okay, so I'm not sure where exactly is a nice area to possibly look for short trades in this market. Because obviously right now we are testing a key level of support around 15,700. So perhaps a bit of a rally initially above Thursday's high is what I would like to see, and then a failure to hold above that high would be a bearish signal for me. Alternatively, a decisive break below 15,700 and then a rounded retest of that could offer a potential shorting opportunity on the Nasdaq. But if you're feeling bullish on the stock markets, perhaps because you reckon that the economy is going to strengthen, then the better index to trade, in my view, would be those indices that have more value stocks rather than growth stocks in the technology sector. So the likes of the Dow in the US or the FTSE in the UK are the markets to potentially look for long trades in. So the Dow has actually reversed after momentarily climbing above last year's high. So waiting for the right signal is key here, and we've broken below this low, which is potentially bearish. I say potentially because it's not uncommon for the market to briefly break prior lows before ripping higher. After all, there tends to be lots of stop orders resting below these types of lows, and in a bullish trend, these types of breakdowns usually fail, and this could well be another such scenario. So if this is a false breakdown, what we need to see first and foremost is a break back above this year's opening level, which is right here, this purple line at 36,400. If we climb above that, then looking for bullish trades would make more sense to me. Or wait for a more significant correction around this zone here, which is the base of the last rally, and then look to potentially buy the dips there or around that area, perhaps after some sort of confirmation. But this level right here, if you're shorter term focused trader, this area between this year's opening level and the low from this bearish candle, we need to zoom in that area and discuss what we are looking out for. Okay, so the most significant or the most recent high is this level here at 36,467. If we move, if the index rallies today on the back of the jobs report, climbs above the this year's opening level and this resistance level we highlighted on the daily time frame, then I would be interested in looking for a clean break above that zone. Yeah, a clean break above that zone, something like this. Let's have a look. Where's it gone? So by a clean move, I mean something like this, okay? Then what I'd like to see is a move back down to this area to look for a long trade to take us towards this green level here, which is last year's high and this old support area, okay? So that would be my first objective. Maybe I'll probably want to keep some in there in case rates, in case the index wants to push further higher and hit a new record high. Obviously, this is not, I'm not providing you any trade advice here. This is merely an opinion of mine, which may or may not work. And in any case, you should do your own research and obviously consider risk management, especially when trading indices, because indices move very fast at times compared to FX markets. So you want to make sure that you don't risk more than a small percentage of your account on any one particular trade, especially during heightened volatility, and especially when you're getting some mixed signals in the equity markets, as we've seen the Nasdaq going down, for example. So yeah, please consider risk management and do your own research rather than relying on anyone else's recommendations. And so yeah, that's my opinion. Let's go back to the currency markets, okay, and look at the euro dollar very quickly. The euro dollar has been stuck in this ugly range. It's very difficult to trade it shorter term because it's not really moving. On the one hand, the Fed is becoming really hawkish. On the other hand, we are seeing strong pickup in inflation in the eurozone as well, 5% now, which is a record high. So the pressure is growing on the ECB to withdraw its support sooner rather than later. Previously, I thought we would get into this zone and then sell off from there and head to 110. But the pause ahead of 110, the lengthy pause ahead of 110, is making me a bit more hesitant now to maintain a bearish view on the euro dollar. Instead, looking at long setups in the dollar Swiss may make more sense, because if you look at the euro Swiss has actually broken above the 21-day exponential. So it could potentially have ended its bearish trend, meaning that the Swiss franc is more could become a more weaker currency compared to the euro. Therefore, going long the dollar Swiss rather than shorting the euro dollar makes more sense. Speaking of the dollar Swiss, it is above this year's opening level, above the 200-day moving average and 21-day exponential. It has broken a short-term bearish trend line. Yeah. So this level right here at 91.83 is going to be important in terms of support. If we get there today, possibly we could see a move higher from there. In any case, I think the path of least resistance for the dollar Swiss is to the upside, especially considering the fact that the Swiss franc is usually considered a haven currency like the Japanese yen. Now, we already mentioned it, that the Japanese yen is in a strong bullish trend, and so the dollar Swiss could now be playing catch up with the dollar yen. And we have some bullish breakthrough right here, haven't we? So maybe looking to go long on dips in the dollar Swiss is an idea that you could consider today after the US jobs report is out of the way. Anyway, we have run out of time, guys. There won't be any time for our usual Q&A. So thank you so much for joining me. For those of you who are watching a recording of this, please ensure you can join us next time live in our regular webinars. So if you go to market analysis, live webinars on Think Markets website, thinkmarkets.com, you will see our upcoming webinars. And the next one is on the 11th of Jan, which is our usual weekly live market analysis webinar. In these live market analysis webinars, we talk about technical charts mostly rather than fundamentals. So if you like the second part of today's webinar on the NFP preview, expect more of the same in the live market analysis webinars. So yeah, join us. You'll see if you like it, you can become a regular subscriber. If not, that's okay as well. But anyway, I want to mention finally that trading non-farm payrolls can be risky because the markets usually, but not always, turn a bit volatile around the data release. So please be careful and wait for the data to come out if you are a conservative trader. Wait for the data to come out, let the dust settle a little bit. Then if you see an appropriate signal to trade on any market that you are interested in, then consider it then rather than ahead of the jobs report. Don't forget that we have the Canadian employment numbers out around the same time as the US jobs report. So the dollar CAD is going to be very volatile around that time. Anyway, take care. Thank you so much for joining me. I will speak to you guys soon.